Now on Overnights,
I believe in reason and common sense.
Leith Van Onselen from Macro Business with the Treasury of Common Sense.
Common sense never goes out of style.
There is a lot of economic news to talk about with Leith Van Onselen from Macro Business this week, particularly with the Reserve Bank leaving interest rates on hold. G'day, Leith.
G'day, Clinton. Hi.
I'm good. Michelle Bullock and the board of the Reserve Bank left rates on hold, which was expected at 4.35%. But she made more comments about inflation during the week, and she did point the finger at the government.
Yeah, absolutely. So listeners might remember that last week I said that we should prepare for a war of words between the federal government and the Reserve Bank on inflation. And I think, this week's Reserve Bank commentary is going to pretty much inflame that, I think. So Reserve Bank Governor Michelle Bullock, after her monetary policy meeting, she basically said that she put the blame for inflation on the government. So in her press conference, she explicitly said that the Reserve Bank had been blindsided by the record public spending. Public demand as a percentage of GDP hit 27.3% in the June quarter. It's never been that high before. And government spending actually drove all of the economy's growth over the quarter. And it's also driven just about all of the jobs growth over the last 2 years. And what she said was that this massive government spending is basically inflating demand in the economy, and that's obviously keeping prices higher, et cetera, because you've got more demand in the economy. There was also a note in the Reserve Bank statement saying that demand's also been pushed up by spending by temporary migrants as well. So obviously we've had record immigration, which is also a federal government issue. And so effectively she pointed the finger at the government or basically pushed back on the government, saying that one of the reasons why underlying inflation is remaining too high at 3.5% is because the federal government is basically, pumping demand while the Reserve Bank's trying to slow demand through interest rates. And what makes this funny is after the recent inflation data that came out a few weeks back, Treasurer Jim Chalmers basically said that, he boasted on Twitter, et cetera, and in the media that the headline inflation rate was within the Reserve Bank's target, which is basically a subtle way of saying they should cut rates. But also Prime Minister Anthony Albanese told a business dinner on Wednesday night that inflation was falling, and he said that it was the first time in years that the inflation rate had a 2 in front of it. Now, of course, Prime Minister Anthony Albanese is referring to the headline inflation rate, which has been basically artificially lowered because of these energy subsidies, rent subsidies, etc. Whereas the Reserve Bank is looking at the underlying inflation rate, which excludes those things. So we've got this, situation whereby the federal government is arguing that inflation's low, the Reserve Bank's arguing that inflation's high. The federal government wants the Reserve Bank to cut interest rates, desperately wants them to do so because it's got to go to an election by May next year. And it knows that if the Reserve Bank doesn't cut rates, it could be in deep trouble politically. Whereas the Reserve Bank's pushing back, saying, no, government spending's too high, underlying inflation's too high, and has basically pushed rate cuts into sometime next year. And based on this data and its commentary, most economists were tipping February next year. Well, based on this, it looks like it could be later than February, which makes it perilously close to the next election. So it's just you can basically just expect more of this and for it to ramp up over the coming months as the federal government tries to pressure the RBA to cut rates, citing the headline inflation rate, and the RBA standing its ground saying, looking at the underlying inflation rate, which is still above the target. And so we're going to have this argy-bargy, I think, for several months. And to their credit, I'm actually quite impressed with Reserve Bank Governor Michelle Bullock for standing her ground because she's under a lot of pressure.
Certainly is. Now, given we're going to an election, it's going to be hardly an environment for Jim Chalmers, and I know he says he's not going to go on a spend-a-thon, but it's going to be an election campaign. Of course there'll be a spend-a-thon.
Yeah, and we already saw it this week with the government basically forgiving about $16 billion of HEX debts. Now that sort of has a bit of a Queensland election ring about it. Obviously the former government in Queensland was handing out subsidies left, right, and centre for everything, trying to basically buy its way back into office, and this HEX announcement sort of reeks of that a little bit, and I think we're going to see some more of that. And it'll be interesting to see how this plays out, with the Reserve Bank's thinking, because they have warned that the government spending is already too high. Like they've pretty much explicitly said it. And it's basically shot across the bows of the government not to go on a spending spree before the election.
You've been talking about a per capita recession for some time. The RBA is also in forecasting that now as well.
Yeah, pretty much. So we've obviously already been in one for 6 consecutive quarters of basically the economy shrinking once you adjust for population growth, and that's actually a record decline. And the Reserve Bank's growth forecast that they released as part of its statement of monetary policy, which came out on Tuesday, I should say, actually downgraded Australia's growth forecast. And so what the Reserve Bank said, they said that the Australian economy is going to grow by 1.5% this year. Now, I know what you're all thinking, oh, that's not too bad, that's growth. But that's in the context of a population growing by about 2% by the end of the year, according to the Reserve Bank. And what that effectively means is that that according to the Reserve Bank's own forecast, we're likely to end up with 10, maybe 11 or 12 consecutive quarters of 8 to 10 quarters of consecutive per capita decline. And it's also worth pointing out that the Reserve Bank's forecasts on the economy are actually more positive than recent forecasts that we got from the IMF, the OECD, and Deloitte. So the IMF tipped 1.2% growth this year, OECD 1.1%, and Deloitte 1.1%, which is obviously lower than the RBA's 1.5%. So pretty much all the forecasts on the Australian economy are still incredibly weak, and they're worse than population growth, which basically means that the economic pie is going to continue to shrink per person. And it already has shrunk for 6 consecutive quarters, or 7 of the last 8 quarters, and it looks like it's going to shrink for potentially 8 to 10 quarters, depending on how the dice lands.
And at a time when labour productivity is down.
Oh, absolute shocker. So the statement of monetary policy by the Reserve Bank basically said that Australia's recovery from recession is going to be really weak. So they gave forecasts out several years, and the recovery from per capita recession is going to be terrible. One of the reasons for that is Australia's labour productivity has actually fallen to 2016 levels, so it's absolutely collapsed. So what labour productivity is, it's basically how much we produce per person, and it's basically shrunk. So it's gone back to 2016 levels, and our labour productivity growth's been really bad since about the mid-2000s. So it's been falling ever since then, and that coincidentally, and it's actually no coincidence, was after net overseas migration was ramped up. So after the federal government ramped immigration in the mid-2000s, we had a huge surge in population, which has run for nearly 20 years. And what that's effectively done is it's created what economists call capital shallowing. So without trying to get too technical, what that means is that if the population grows faster than we grow business investment, the amount of infrastructure we build or the amount of housing, basically we get lower productivity growth because you got less capital per person. So to give a very basic example of that, if you run a cafe and you've got 2 workers working off one coffee machine and you can produce 50 coffees an hour, if you double the number of people, so if you have 4 people sharing that coffee machine, your output's not going to double because you'll end up having congestion. You'll have to wait for the other person to finish making their coffee before you can make your coffee. You'll bump into each other, all those sorts of things. That's effectively what the Australian economy has done for 20 years. We've added more and more people, but we haven't added the capital investment, the infrastructure, etc., to cope with those people. What it means is that you end up with more congestion, people doing less than they can because there isn't enough capital.
And so is the productivity down because we don't create the environment with the right infrastructure to get the best out of people, or are we bringing in the wrong people?
Look, there's certainly an argument about bringing the wrong people as well. So that is definitely an argument, but we definitely do have capital shallowing. So capital shallowing, we've basically grown the population by 8.5 million people this century, and we haven't built the infrastructure to go with the business investment outside of mining or the houses to house those people. And as a result, we've got lower productivity. And in fact, an independent economist named Jared Minnack, who used to be the former chief economist of Morgan Stanley, he's gone out on his own with his own advisory, very excellent economist. He published research on Wednesday, which basically put numbers around Australia's capital shallowing. And he showed that basically our net investment spending as a share of GDP has fallen to recessionary levels at the same time as we've grown the population aggressively for 20 years. And what it's done is it's basically put the real capital stock per person. So if you think about that coffee machine example I was just saying a second ago, it's sent it to record lows, which has basically shrunk our productivity growth to really poor levels. That's led to us having very poor per capita GDP growth. And these are the sorts of arguments. I've been making these arguments for years, but he actually put some numbers around it. And he also noted that when Australia had its productivity boom in the late 80s to 2000s, They always talk about that being the golden era. We had these microeconomic reforms and all those sorts of things everyone's probably heard about. But another reason why the productivity was so good is also coincided with the slowest population growth in the post-war era, was between 1980s and 2000. And now we've done the opposite. We're not doing all the stuff we did then, but we're also growing the population aggressively, and we've got this capital shallowing. And the dilemma it leaves for us, it's kind of left us in a bit of a catch-22, because the federal government has committed to this permanently high population growth pretty much forever, which is going to grow the population by 13 million in 39 years, a ridiculous amount of people. And what this basically means is we're going to need massive investment in housing, infrastructure, business investment, all this stuff just to stop our productivity from falling. And basically, it's an impossible task. We can't simultaneously have high population growth, high housing investment, and high infrastructure investment. It's not going to happen. And we've actually seen this in New South Wales in the last month, because we've had the New South Wales Productivity Commission, Mirvac, Treasurer Daniel Mookie all say that New South Wales has got to divert its spending from infrastructure into housing. You might have heard that in the last month or so.
Oh, yeah.
Yeah, and yet the Committee for Sydney has said the opposite. They said, no, we need more infrastructure spending. We need more spending on metro trains and trams and all those sorts of things to solve the housing crisis. Now, this is kind of an example of Australia's capital shallowing problem, because, both these groups are saying that we need to do these two things to keep up with population growth, but really you can't do all of it. You can't have high population growth, high investment in housing, and high infrastructure. That's why these groups are saying, no, you can do infrastructure but not do housing, or you can do housing but not do infrastructure. But if you've got population growth, you need both. And if you don't do both, you're going to end up with worse productivity and this capital shallowing effect. And this is why I keep saying the optimal solution for Australia is productivity, housing, infrastructure, etc., is to significantly wind back immigration back to the kind of levels we had in the 1990s when we didn't have all these problems. And that would allow us to actually have capital deepening, where you can actually grow your infrastructure, your housing, your business investment faster than you grow your population, which means that you become more efficient, and it means you end up with higher productivity growth. But unfortunately, Australia's doing everything back to front, which is one of the reasons why our productivity is so poor. And I don't think enough economists talk about this. They don't talk about this simple fact that Australia has just grown too fast for 20 years, and we've outrun infrastructure, housing, etc., which is one of the reasons why we've got poor population growth. And anybody living in Sydney knows this, because you've lived it for 20 years. It's so much harder to get around now than it was 20 years ago. It takes you much longer. That is all productivity destroyed. Yeah. And that's one of the reasons why our productivity is so poor.
Yeah, it's spot on. We experience it all the time in Sydney with congestion, and the Minns government made it clear when they came to power they're not going to be an infrastructure government. Their priority is not that whatsoever. It needs to be an issue heading into the federal election. Always good to talk to you, Leith. We will catch up next week.
Cheers, Clinton. Thank you.
Leith Van Osselen.